Hello, welcome to Accounting with Arpit Garg. In our last video, we started admission of a partner and studied change in profit sharing ratio. Today, we are going to start our second topic, that is accounting treatment of goodwill. We have already studied concept and valuation of goodwill in our previous chapter. Today, we will just see how we will record the general entries for the treatment of goodwill. We will try to understand the concept so that we need not by heart the entries. At last, we will solve a question related to treatment of goodwill. As I told you, I never calculate sacrificing ratio, so you can see the full video and check out the method which I follow to pass entries regarding goodwill. Let's start. First case is when premium for goodwill is paid privately. Remember, the portion or the amount of goodwill which incoming partner brings or which a new partner brings will be termed as premium for goodwill. So, when premium for goodwill is paid privately, we know that the amount is not coming to the business, and as nothing is coming to the business, so there will not be any entry. Next, when premium for goodwill is brought in cash by incoming partner and is retained in the business. Here, partner is bringing premium for goodwill, and that amount the old partners are keeping and using in the business itself. So, let's look at the entries. First, partner is bringing the amount for premium goodwill. As we are getting an amount, as we are getting cash, so we will debit cash or bank account. Then we are getting premium for goodwill, so credit it. So entry is cash account debit to premium for goodwill. Now, this premium for goodwill will be distributed among old partners or the partners who are sacrificing their share for incoming partner, as we studied in our last class. So here also we will debit premium for goodwill and will credit partner's capital or current account. Now calculation of amount we will learn whilst doing the question in the last of the video. Let's look at once again. When premium for goodwill is brought in cash, so cash account debit to premium for goodwill, it is retained in business, so no need to pass any entry because this cash is just coming and lying in the business. Then this has to be distributed among sacrificing partner. So premium for goodwill account debit to sacrificing partners capital or current account, as the case may be, of fixed or fluctuating capital. Then next, when premium for goodwill is brought in kind. Now partner is not bringing cash but is bringing some asset for his goodwill. So asset account debit and rest of the entries will be same to premium for goodwill account debit to sacrificing partners capital or current accounts. Understood? Next, when premium for goodwill is brought in by incoming partner and is withdrawn by sacrificing partner either fully or partly. So here first part of our case is same. Premium for goodwill is brought in by partner. So first they will bring in, so cash account debit to premium for goodwill. Then that will be distributed among sacrificing partners. So premium for goodwill account debit to sacrificing partners capital or current account. Now this amount which sacrificing partners are getting, they are withdrawing from the business either fully or partly. So by whatever amount they will withdraw, cash will go from the business, so to cash or bank account, and as partners are withdrawing, and we know whenever partners withdrew any amount, that is called drawing, and drawing decreases partners capital. Partners capital account balance is credit, so to decrease it we will debit, so sacrificing partners capital or current account debit. Once again, cash or bank account debit to premium for goodwill. When we get cash for the goodwill, then to distribute this among sacrificing partner, premium for goodwill account debit to sacrificing partners capital or current account. Now this you can do either in sacrificing ratio or according to the method which I am going to tell. Then sacrificing partners capital or current account debit to cash or bank account, recorded as drawing. Next, when incoming partner is unable to bring premium for goodwill either fully or partly. Now here partner is not able to bring premium for goodwill, but we want the amount. So what we will do is, first we will take the amount as he is giving. So for example, we ask him to pay 1000 rupees, but he is paying 60%, means 600 rupees he can pay. So cash we will take 600, we will debit it. Then to premium for goodwill 1000 rupees, because we want 1000 rupees. Now he is giving rupees 400 less. For that we will open his current account with debit balance. So incoming partners current account debit. Once again, whenever partner will not bring or will not bring full amount of goodwill, we will open incoming partners current account to adjust the amount. Then this premium for goodwill will be distributed among sacrificing partners. So this entry we have already studied. Next, hidden or inferred goodwill. Now here things are same, I think. Goodwill is hidden, so here I need to find out the value of goodwill, which we have already studied earlier. So now we will see in short how to calculate that. But we are studying treatment, as I told you in the beginning. So treatment will be, okay, amount of goodwill is hidden, but either he will bring in cash, or he will bring in asset, or he will not bring. Whatever the case may be, we have already studied. So here we just need to find out the value of goodwill. Accounting treatments are over. Whatever we have studied till now will be the treatment only for premium of goodwill. So let's see how hidden goodwill or inferred goodwill is calculated. First, look at the incoming partner's capital, whatever capital he is bringing. Then look at his share of profit. Then divide both the amounts. We will get net worth. And remember, this is net worth including goodwill. Then we will calculate net worth excluding goodwill. For that we have two methods. First, adjusted capitals of old partners plus capital brought in by new partner. Now capital brought in by new partner we already knew, as we have written in our step A. What is adjusted capital of old partner? It means capital of old partners plus or minus reserve, whatever we have studied, accumulated profit, accumulated losses, reserves. Okay, then other is sundry assets minus outside liabilities. It will also give us how much net worth we have introduced in our business. Then we will find goodwill by deducting both the amounts of step C and step D. Simple. Let's check out once again. First, write incoming partner's capital account. Write his share. Divide both the amounts. We will get net worth, including goodwill. Then find net worth excluding goodwill by adding all the capitals of all the partners, adjusted ones, or sundry assets minus outside liabilities. Then we will deduct both the amounts we got, we will get the amount of goodwill. Now, one more method when goodwill is already appearing in books of accounts or goodwill is appearing in balance sheet, we can say. So if we see balance sheet and there is goodwill, so this goodwill we have to distribute among ourselves before new partner joins. So as we know, goodwill is intangible asset. Being an asset, it has debit balance. Now to distribute this, we will credit this. Then we will give this to partner. So old partners capital or current account debit. So this will be distributed among old partners in their old profit sharing ratio. That's it. Now we have studied all our concepts. If you have doubt in any concept, you can please rewind the video and watch it once again to brush up the concepts. First, you need to clear the concept so that you can solve any question yourself without by-hearting all the entries, because there are so many entries in accounts. If we will go to learn them again and again, it will create a problem. So it's better to understand the basic concept and to draw all these entries ourselves. Okay, now let's start our question. You can please pause the video and write down the question. Done. Let's read it at once. X and Y are partners in a firm sharing profits and losses in the ratio 3:2. So old profit sharing ratio is 3:2. They admit Z as a partner for 1/5 share. As agreed between themselves, X and Y decided to share future profit in the ratio 13:7. So with the help of these three lines, we will calculate a new profit sharing ratio. As I told you in previous video, this is the first thing we are going to do in every question. Then goodwill of the firm is valued at 4 years purchase of super profit based on average profit of last 3 years. This concept we studied in our last chapter. Average profit and normal profit are 3,40,000 and 1,50,000 respectively. Goodwill already appears in the books at 80,000. This concept we studied just now at the last. Z brings in 70% of a share of firm's goodwill and rupees 3 lakh as his capital. So he is bringing part of goodwill. The amount of goodwill is withdrawn by the concerned partners to the extent to 50% of the amount credited to them. Now here partners are withdrawing their goodwill. Pass necessary journal entries to adjust goodwill and to distribute profit. So I think we have done. So I think this question includes all the entries we have studied till now. Let's try to calculate this. Make page for journal entry and start with our working notes. First, calculation of new profit sharing ratio. Let the total share be 1. Then Z's share 1/5. Now I am not explaining every step in detail because that we have already done in our last video. If you have not seen that, you can please go back to that video and learn how to calculate new profit sharing ratio in detail. So now remaining share, after giving share to Z, how much is remaining with us? So 1 minus 1/5, it comes 4/5. Then question said that this remaining share will be distributed among all partners in ratio 13:7. So this 4/5 is to be distributed by among X and Y in ratio 13:7. So X new share will be 4/5 remaining share into 13/20. 20 is 13 plus 7. So into 13 by 20, it comes 13 by 25. Then Y's new share will be remaining into Y's share. So remaining is 4 by 5 into Y is going to share profit in 7 part. So 7 by 20, it gives 7 by 25. That's it. New profit sharing ratio of X, Y and Z is equals to 13 upon 25 ratio 7 upon 25 ratio 1 by 5. So here we can see that denominators are not equal, 25, 25 and 5. So we will make it all 25. So 13 upon 25, 7 upon 25 ratio. Now to make denominator 25, we need to multiply 5 by 5. So 5 5s are 25, 1 5s are 5. So it comes 5 by 25. Then we will remove all the denominators as they are same. So new profit sharing ratio of X, Y and Z will be 13 is to 7 is to 5. Done. Now let's come to our journal entry. First, partner is bringing in capital, but before that I told you, first thing we will do is we will distribute all the entries or all the accounts which we are having before joining our partner. So as question said, we are having goodwill in our balance sheet. So first we will distribute that in old profit sharing ratio. So goodwill given was 80,000. So X capital account 48,000, Y's capital account 32,000 to goodwill 80,000. From where we got this? Goodwill is given in question 80,000. Then 80,000 into 3 by 5 will go to X. 80,000 into 2 by 5 will go to Y. Then Z is bringing in 3 lakh rupees. So bank account debit 3 lakh to Z's capital account 3 lakh. Done. Now the only entries left are for goodwill. So first let's calculate goodwill. Let's come back to our working notes. Calculation of goodwill of the firm. So we are given average profit as rupees 3,40,000 and normal profit as rupees 1,50,000. We will deduct both the amounts and will derive super profit, which comes as 1,90,000. Then goodwill is at 4 years purchase. So 1,90,000 into 4 will give us rupees 7,60,000. This is goodwill of the firm. Now this goodwill will be distributed among partners? No. Only we will calculate Z's share because Z is bringing in goodwill. So what you will see in most of the questions that here they will tell you to find out Z's share. Then that they will tell you to distributing sacrificing ratio. For that you need to calculate sacrificing ratio also. But what we are going to do is we will just make a table particulars X, Y, Z. Distribute this 7,60,000 in old profit sharing ratio, that is 3 by 2. You will get 4,56,000 and 3,04,000. Then distribute same amount 7,60,000 in new profit sharing ratio, that is 13 is to 7 is to 5. So 7,60,000 into 13 by 25 into 7 by 25 into 5 by 25. Deduct the amounts. Then 4,56,000 minus 3,95,200 will give 60,800. 3,04,000 minus 2,12,800 will give 91,200. 0 minus 1,52,000 will give minus 1,52,000. And here you must also remember that Z is bringing only 70% of his goodwill. So we will distribute this in two parts, 70% and 30%. Now we will post our entries. But before posting entry, let me tell you two things which you need to remember to follow this method. First thing is, you need to find out goodwill of the firm. So in any question, if you are giving Z's share, for example, in this question they have given Z's share of goodwill is 1,52,000. So you will multiply 1,50,000 into 5 by 1. That is, you will divide Z's goodwill or incoming partner's goodwill by his share of profit to arrive at goodwill of the firm. Because we are distributing goodwill among all the partners, so we need to find out goodwill of the firm. First thing. Second thing is, you see these differences. X balance is positive, so we will credit this. Y's balance is positive, so we will credit this. Z's balance is minus, negative, so we will debit this. So these two things you just need to remember. First, find out goodwill of the firm. Second, we will reverse the things. For positive, we will credit, and for negative, we will debit. Let's see. While solving question or while writing entries, you will understand more. So, partner is bringing in premium for goodwill. So, we want 1,52,000 from him. To premium for goodwill, 1,52,000. He is giving only 70%. So bank account debit 70%. That is 1,06,400. And rest of the amount, yes, we will take from his current account. So Z's current account debit 45,600. Then this is to be distributed among partners. So you have seen Z's balance was positive, so we will credit to Z's capital account 60,800, to Y's capital account 91,200, and debit premium for goodwill 1,52,000. Now partners are withdrawing 50%, so 50% of 60,800, X will withdraw 50%, that is half of 91,200. Y will withdraw because they got this much amount in our second entry on this page. Now as they are withdrawing, so money will go from the firm, so to bank account 76,000. I hope the question is clear to you, but as I have explained many topics or many methods in the same question, so please rewind the video and watch it once again to brush up the concept. And please try to first listen to everything and then make a note of it so that you can clear the concepts easily. That's it for today. If you like the class, you can press the thumb up button and subscribe the channel also. Thank you. This is Accounting with Arpit Garg signing off. Bye bye. Take care. Keep learning. Stay safe. Jai Hind.